We have a community question that has come in from Daniel.
Yeah, that's right. We love getting these questions, so keep sending them in. equitymates.com/contact. This one is about gold. So Daniel writes, I keep reading gold is safe and can help my portfolio when stocks are down. What I don't understand is how. Should I be rebalancing my portfolio in these times with returns from gold? Or does it just make you feel better about your losses? Does it only help when you rely on an income and doesn't really affect long-term growth seekers? So a few different aspects to that question there. So we thought this was a good opportunity to just talk about gold generally and answer some of those questions as we go.
Well, let's start with the basics of gold as an investable asset because there's no doubt that it's had a pretty decent run. Pretty consistent run.
It's
I
had a
should
pretty
say.
decent run for literally thousands of years.
Yeah.
Like that's the thing with gold. It's like it's been a store of value literally through empires.
Everything.
Through
Yeah.
epochs of human history.
Yeah.
But we pulled some numbers from 1971 when Nixon removed the US from the gold standard. Then the price of gold was $43 an ounce. It's now about $1,500 an ounce. That works out to be a compound annual growth rate of just shy of 8%.
Not bad.
So like gold has been a pretty consistent performer. And that's really why people will include it in their portfolios.
Yeah. So let's speak about the role of gold in portfolios, and it always starts with, and this is why people talk about, it's a good idea to have some level of exposure. It's because gold historically has been counter-cyclical, meaning that it's been used to provide mitigation during times where there's market stress. Counter-cyclical essentially means it moves in the opposite direction to stock markets. Historically.
Yeah. So that's the first reason. And then the second reason is it's seen as a hedge against inflation. And so, that's the whole store of value that both as prices rise, gold will generally rise with it. And as currencies get devalued, gold will hold its value. And so the idea is that gold preserves your purchasing power. And so that's sort of where it sits in a portfolio. So State Street, the big financial institution, did some analysis. Now, this is from the US, but since the 1970s, during periods where the annual rate of inflation has been below 2%, the gold price has risen at an average rate of 7.8% a year. So not bad, not bad. But where gold really shines is in periods where there's high inflation. So when inflation was above 5% a year, gold has increased by an average annual rate of 16.2%.
Wow.
And that's because, the price
Flight to
has
asset.
risen, but then it also, as inflation is high, gold is obviously getting that inflation kick as well.
Yeah.
So that's really the two reasons you have it in the portfolio. Yeah.
So then let's address Daniel's questions with how individuals can use it in your portfolio. So he wanted to understand how and why it helps when his stocks are down, and then also around rebalancing. So most model portfolios have a general allocation of roughly 5% to gold, if they have one at all.
If they have one at all.
Meaning they don't say 1%, 2%. It's roughly, if we're going to have gold in the portfolio, it's generally about 5%.
Yeah. But you'll find a lot of model portfolios don't have gold.
Yeah.
And that's just a choice that you make. But yeah, it's not like you're not going to find a model portfolio with 50% gold.
No.
Yeah.
No. So that's the first thing, Daniel, when you're thinking about how much gold to put in your portfolio. The second reason around, how it makes your portfolio better with gold in it is that when the market falls, simply a portfolio with gold in it should fall less is the crux of it. We've spoken about how it's counter-cyclical. So when your stocks are falling and gold is going up, or at least holding its value, your portfolio is going to fall less. We're not saying your portfolio is going to stay where it is or go up, primarily because you've got a small allocation to gold, but it's just going to fall less.
And then I guess to answer Daniel's question about the how, and he asked, do you rebalance your portfolio or does it just make you feel better about your losses? It's certainly not just a psychological here to make you feel better, but it's more, let's say the market falls meaningfully and gold rises a little bit, And as a portfolio weight, gold was 5%, but it becomes 10% of your portfolio. At that point, you can rebalance and you can sell some of that gold and buy equities. And in theory, then you've been protected as the market has crashed because gold has been counter-cyclical, so your portfolio hasn't fallen as much. But then also you can take that opportunity to rebalance and buy some equities at the bottom of the market before it rebounds. So that's the theory about where gold can sort of play a counter-cyclical role in your portfolio.
I don't have any gold in my portfolio. I used to. I think I had about 4%, but I sold out.
Yeah, I am the same. I used to. Gold matters if you care about year-to-year portfolio performance, if you want to minimize volatility, and if you measure risk by the volatility of a portfolio. Philosophically, that's not how I measure risk. Like, my risk tolerance is higher in the sense that not that I'm investing in crazy risky assets, but that I can tolerate year-to-year volatility.
Yeah.
I don't consider that a measure of risk for me.
Yeah.
For me, risk is a loss of permanent capital.
Yeah.
And so if the market meaningfully falls, I can wear that knowing that it will recover, knowing that I'm working a job and earning income, and that I'm dollar cost averaging into indexes, but also stocks that I want to buy at different times. And so that's why I took gold out of the portfolio, because I was like, I don't feel like it's really serving a purpose for me and how I invest and how I think about my goals and my time horizon. Why did you sell it?
Exactly the same
Yeah,
reason.
okay,
Yeah. Just I felt the money could be better served elsewhere, and I for exactly that reason don't need it. Yeah.
If you do want to have gold in your portfolio, there's a age-old debate between, do you buy physical gold or do you buy gold miners? And there's no right or wrong answer, but I would say that for the purpose that we spoke about today, as gold in your portfolio, you probably want to lean towards physical gold. And the reason being that if you buy gold miners, you generally get more upside. When gold is going well, the gold miners sort of, there's like a little bit of leverage there. Like if gold goes up 50%, the gold miners might go up 80%, 100%. Like, so that, and that's why some people like gold miners. But the opposite is also true. If the overall stock market is falling, these gold mining stocks will likely fall as well, just because like the overall market is falling. And so then it's not really playing that counter-cyclical role in the portfolio. So that's just my 2 cents. People argue both sides of it. There's no right or wrong answer. It's just what you want out of your investment. And my final thought, if you do want to invest in gold, is there are ETFs that invest in physical gold, and there are ETFs that invest synthetically to track the price of gold. Go under the hood of the ETF, look at the issuer's website, and find one that actually holds physical gold.